Good morning and welcome back to your daily market briefing. It looks like we're heading into a shaky Friday for European stocks, with many markets poised for a lower open. The big concerns swirling around are a potential bubble in the artificial intelligence sector and broader worries about where the global economy is headed. These jitters are definitely shaking investor confidence this morning. Looking at the early numbers, futures for London's FTSE 100 are pointing about 0.5% lower. It's a mixed bag elsewhere, though. Germany's DAX futures are actually up slightly, by about 0.2%. But France's CAC 40 and Switzerland's SMI futures are both in the red, down 0.4% and 0.8% respectively. So, a bit of a scattered picture across the continent as we kick off the trading day. A major factor weighing on sentiment is the latest economic data coming out of China. The numbers for October show a pretty significant slowdown. Fixed asset investment, which is a key indicator that includes the closely watched real estate market, actually contracted in the first 10 months of the year. On top of that, retail sales have softened, and industrial output growth has also slowed down. These figures from the world's second-largest economy are sending ripples through global markets, raising concerns about demand and overall economic health. Adding to the pressure, investors are still processing the heavy losses we saw on Wall Street yesterday. The U.S. markets took a hit, driven by growing fears that the incredible run-up in AI stocks might be overdone. Valuations are being questioned, and this, combined with uncertainty about the Federal Reserve's next move on interest rates, created a perfect storm for us. The tech sector was hit especially hard, with the Nasdaq Composite dropping a hefty 2.3% by the close. Speaking of the Fed, the narrative around interest rates has shifted quite dramatically. Just a few weeks ago, a rate cut in December felt like a sure thing, but recent comments from various Fed officials have poured cold water on that idea. They've been sounding more cautious, and that's forced money markets to seriously rethink their expectations. As of this morning, the market is only pricing in about a 52% chance of a quarter-point cut at the next meeting. Compare that to a month ago, when the probability was a massive 95%. That's a huge swing and shows just how much uncertainty is back in the picture. But it's not all doom and gloom. Back in Europe, the corporate earnings season is still providing some bright spots. German insurance giant Allianz, for example, just reported their results for the first 9 months of the year, and they've achieved record numbers. Their operating profit in the third quarter alone jumped nearly 13% to 4.4 billion euros, thanks in large part to a strong performance in their property and casualty division. Off the back of these strong results, Allianz now expects its full-year operating profit to hit at least 17 billion euros, which is at the very top end of their guidance. It is a great example of how some well-run companies are still managing to thrive in this challenging environment. Looking back across the pond, U.S. stock futures are relatively flat this morning. It seems like the market is taking a moment to breathe and digest yesterday's big There isn't much movement in either direction in the pre-market, suggesting traders might be waiting for the next catalyst before making any big moves. And just to round things out, markets in the Asia-Pacific region had a tough session overnight. Stocks there fell as investors reacted to the sell-off on Wall Street and, of course, that weaker-than-expected economic data from China. It really highlights how interconnected the global markets are, with weakness in one region quickly spilling over into others. So, to sum it all up, we're starting the day with a cautious tone. Lingering concerns about AI valuations, the Chinese economy, and central bank policy are all weighing on investor minds. We'll be keeping a close eye on how these themes develop throughout the day. Thanks for tuning in. Make sure you're subscribed for all the latest updates, and we'll see you in the next video.